So today we are starting chapter 13, which covers corporations. We won't do the whole entire chapter. We will skip around through some of it. We're just going to concentrate on the basics with respect to corporations. Okay, let's see. All right, so you might remember that corporations are separate legal entities. So unlike a sole proprietorship, a corporation can be separated from the person. All right, with a sole proprietorship, the person is the business, basically. All right, but corporations are separate legal entities, and they're the most dominant form of business in the United States, usually because they have several advantages that they offer. All right, and the one that a lot of people like is that limited legal liability. All right, a lot of people like to incorporate because it offers them the protection of limited legal liability, which means that if the corporation gets sued, they can only take the corporate assets, not your own personal assets. However, you need to be very careful with this because if you're a very small corporation and you tend to just treat it like a sole proprietorship, then they might take away that protection. So you have to watch out for that. You can also transfer ownership very easily. You know, with a sole proprietorship ends when that person gives it up or dies or whatever the case may be. But with corporations, you buy and sell stock on a daily basis. The owners change every day. All right, and it's easier to raise money, or what is otherwise known as capital. Okay. Because you can sell stock and get money, you can borrow money, and since you have more backing you up, it's easier to borrow money. So there's some advantages to being a corporation. All right, so here's some of the stuff that I was just talking about. All right, some of the disadvantages, however, might be double taxation, meaning that dividends are not deductible by the corporation. So taxable income doesn't decrease when a corporation pays dividends. So they're basically paying tax on that income at the corporate level. And then when the shareholders receive the dividend, it is taxed as income. So basically it's taxed twice. So disadvantages, double taxation of dividends, government regulation, is there's a lot of stuff, that paperwork that goes along with being a corporation, and it's a little bit harder to start up. You know, there's more things you have to go through legally when you're incorporating than if you're just doing a sole proprietorship. Okay, so we're going to really kind of focus on stockholders' equity in this section or in this chapter. And we've talked about stockholders' equity before. We've been using it all along. All right, so we have stockholder equity. Corporations, well, you know what? Let me go back here. We're basically going to have two sections for stockholders' equity. We're going to have paid-in capital, which is where shareholder investments go. And we're going to have retained earnings. All right, and retained earnings is accumulated profits and losses throughout the years, less dividends. All right, so we're going to divide our equity section up into those two categories, and we've been doing that all along, so it's not really anything new. We've really just been doing common stock, though, but now we're going to put common stock into paid-in capital because we're going to have a little bit more than just common stock. All right, so in the equity section, you're going to have common or capital stock, All right, and there are some terms that go along with this. Authorized shares are the total number of shares that a corporation can issue. And it's authorized by the state where you're incorporated. So if you want to change that number, you have to go back and get permission. All right, issued shares. They've actually been issued by the court. Outstanding stock is stock in the hands of shareholders. And they may not be the same, because sometimes you may have bought stock back, and so your issued and outstanding might be a little bit different. All right, and shareholders receive stock certificates for their ownership. All right, I'll read through this. We won't have any of this on the test, but there's some basic things that you need to know. All right, stockholders have basic rights. All right, right to vote. Share of profits. This is what dividends are. Share of assets in event of liquidation. And preemptive right, which we won't really do much with this in this semester, but you will in later semesters. All right, a preemptive right means that if additional stock is issued, they have first dibs at buying. So that their ownership stays the same. All right, now you may also have preferred stock. All right, preferred stock is preferred with respect to dividends and assets in event of liquidation. All right, they don't usually get the right to vote, though. Should be event. All right, and then some other stuff we need to talk about. Common stock, well, all stock, I shouldn't just say common stock. Stock may have a par value, which is an arbitrary amount assigned to each share of stock. All right, stock cannot sell below par value. Sometimes it's called a stated value. And you may also have no par stock. All right, it all depends on the requirements of the state where you're incorporating. But whether it has a par value or a stated value or a no par, then it affects the journal entries that we're going to be doing. All right, we already talked about that. All right, so now we're going to do the issuing stock price, issuing stock. Okay. So, journal entries for stock issuance. All right, so Smart Touch. You know what? Let me just copy that over. That would be easier. Okay, so this is the journal entry. The journal entry is if the stock has a par value. All right, Smart Touch Learning's common stock carries a par value of $1 per share. The charter authorizes 20 million shares of common stock. The stock issuance of 15,000 shares at par value is recorded as. Okay, so they issued it for cash. You know, generally you're gonna issue for cash. Sometimes it might be in return for another asset. All right, so we're gonna have cash, and they issued 15,000 shares at par value, so $1. And then we're going to credit common stock, and that is also going to be 15,000 shares at $1. All right, the common stock account is, I'm going to say always, but sometimes you have no par stock. But if you have par value, common stock is always credited for par value. Okay, let's see what the next one is. All right, then they issued an additional 3,000 shares for $5 per share. Okay, so it's still the dollar par value, but now they're going to get a little bit more money. So they did cash. They got 3,000 shares at $5. All right, common stock. This is what I meant earlier. Common stock is always going to be for the par value. So this is still going to be 3,000 times $1. All right, so it's 3,000 times the dollar par. All right, common stock is only credited for the par value. And then the difference goes into an account called paid in, I'm just going to say paid in excess of par. A lot of times I'll just say paid in excess, so keep that in mind. And it's the difference between the two. All right, if you wanted to actually calculate it out, it'd be the 3,000 times what they sold it for minus par. Okay, paid in excess. Okay, and then when you look on a balance sheet at this point in time, notice they've got the common stock at the par value, which was the 15 and the 3. Okay, paid in capital in excess of 12 for total paid in capital of 30. And then retained earnings is underneath that to get our total equity. All right, now if it's no par common stock, so let's just do assume same transactions, but no par. All right, so this is no par. All right, so then you would have cash and common stock for the 15. And then I would have cash for the 15,000 again and common stock for 15 again. All right, because there's no par value, so everything just goes into the common stock account. And then on the balance sheet, you would not have any paid in excess. So when it's no par, there is no paid in excess of par. Okay, if it's a stated value, if a stated value is given, stated value is treated the same as par value. So your entries would be just like they were for the par value. Now, if you issue stock for something other than cash, All right, you record it at the fair value of the asset received. So you generally record at fair value of asset received. Okay, or fair value of the stock, and then it's generally whichever is more determinable. All right, so in this case, they received furniture, and the furniture had a market value of $18,000. So you're going to debit the furniture for $18,000. Common stock still goes at the par. So in this case, we issued 5,000 shares of our dollar par. So that's going to be 5,000, and then the difference goes into paid in excess. All right, when you issue preferred stock, it's the same. Issuance of preferred stock is the same. You just credit the preferred stock account. Rather than common stock. All right, but all the entries are the same. And then notice when you have preferred stock, it's listed separate. So in paid in capital, we would have preferred stock, the paid in excess for preferred stock, the common stock, and the paid in excess for common. All right, I'm going to stop that video there.